Imagine you wake up tomorrow morning. Your phone lights up with breaking news alerts. Major global powers have entered a direct military conflict. Financial markets around the world immediately halt trading. Oil prices spike overnight. Commercial flights are grounded. Shipping routes begin shutting down. Governments begin announcing emergency economic controls. Within just a few hours, the global economy starts shifting. But while governments prepare for war, investors everywhere are asking one urgent question: what happens to my money? When large conflicts begin, financial markets react extremely quickly. Investors move fast to protect their wealth. Some assets collapse, some assets surge, and interestingly, some countries actually become wealthier during periods of global instability. Today, we will break down exactly what happens to your investments if a global war begins. More specifically, we will explore how the situation might affect people living in 3 different parts of the world: the United States, Dubai in the Middle East, and Singapore. Each of these places plays a different role in the global financial system. The United States hosts the world's largest capital markets. Dubai sits at the center of global energy and commodity trading, and Singapore functions as one of Asia's most important financial safe havens. When global conflict begins, investors in these 3 locations may experience very different financial outcomes. What happens to financial markets first? When war begins, the first reactions usually appear in financial markets. These reactions happen very quickly, sometimes within minutes. There are several patterns that have repeated throughout modern financial history whenever geopolitical conflicts escalate. The first major reaction is that stock markets usually fall sharply. War creates uncertainty. Businesses depend on stability. Companies rely on global supply chains, predictable energy costs, and functioning transportation networks. When war begins, these systems become threatened. Factories may lose access to materials, shipping routes may become dangerous, production facilities may shut down. Because energy supply becomes uncertain, traders push prices higher. Historically, oil prices during conflicts have risen anywhere from 30 to 80%, depending on how severe the disruption is. The second reaction is that safe assets rise in value. When uncertainty increases, investors move their money into assets that historically preserve wealth. These assets are often called safe havens. Examples include gold, government bonds issued by stable countries, strong currencies, and sometimes digital assets like Bitcoin. In times of crisis, investors are not necessarily trying to earn large profits. They are primarily trying to protect their capital. The fourth reaction is that money flows toward politically stable countries. When the world becomes uncertain, investors search for places where their wealth can remain secure. They look for countries with strong institutions, stable governments, reliable banking systems, and neutral geopolitical positions. Financial hubs like Switzerland and Singapore have historically benefited from this effect. Large amounts of global capital often move into these locations during times of instability. Scenario 1. If you live in the United States. Let's begin with the United States. The United States hosts the largest and most influential financial markets in the world. If a global conflict begins, the U.S. stock market would likely react immediately. In the early stages of war, markets often fall sharply. This decline is usually driven by panic selling. Large investment funds frequently reduce their exposure to risk when uncertainty increases. Investors begin worrying about corporate profits. Many American companies depend on global supply chains. For example, semiconductor chips may come from Taiwan. Manufacturing may take place in Asia. Rare earth materials may come from different parts of the world. If war disrupts these networks, companies may struggle to produce goods efficiently. Many industries are particularly vulnerable during war. Airlines and tourism companies often experience large declines when war begins. International travel typically drops quickly during geopolitical crises. Technology companies that rely on complex international supply chains may also face challenges. However, not all industries perform poorly during war. Some sectors may actually benefit. Defense companies often receive increased government contracts during periods of military expansion. Energy companies may benefit from rising oil and gas prices. Cybersecurity companies may see increased demand as governments strengthen digital defenses. Another important factor during global crises is the strength of the US dollar. The US dollar is the world's primary reserve currency. During times of uncertainty, global investors often buy US Treasury bonds. This increases demand for the dollar, which can cause it to strengthen. For individuals living in the United States, the financial effects of war may appear in daily life. Energy prices may increase, transportation costs may rise, inflation may accelerate. Governments may increase military spending, which could affect interest rates and fiscal policy. In extreme situations, governments may also increase taxes to fund wartime expenditures. For investors, the outcome depends largely on what assets they hold. Someone with a diversified stock portfolio may experience temporary losses during the initial market shock. Someone invested in defense companies or energy producers may experience gains. Someone holding government bonds may benefit as investors search for safe assets. Scenario 2. If you live in Dubai and the broader Middle East. The Middle East plays a crucial role in the global energy system. Many countries in this region are major oil and gas exporters. Because of this, geopolitical conflict can affect the region differently compared to other parts of the world. If war threatens major oil supply routes, global energy markets can react dramatically. Oil prices may surge. Energy companies may become significantly more valuable. Governments that export oil may receive higher revenue as prices rise. This can create economic windfalls for some countries. Sovereign wealth funds in the region may see their assets increase in value during periods of rising energy prices. However, the situation can also create volatility. International investors may worry about regional instability. Some investors may move money out of the region if they believe the conflict could spread. Local stock markets may experience large fluctuations. Currency stability can become a concern. If investors fear prolonged geopolitical risk, certain regional currencies may weaken. For investors, the asset performance may differ dramatically. Energy companies may perform extremely well. Local equity markets may become volatile. Gold may become more attractive as investors seek protection from instability. Scenario 3. If you live in Singapore. Now let's consider Singapore. Singapore is one of the most important financial centers in Asia. During periods of global instability, Singapore has historically acted as a financial safe haven. There are several reasons for this. Singapore has a strong and well-regulated banking system. It maintains political stability. Its foreign policy is generally neutral, and it serves as a financial gateway connecting global capital with Asian markets. When global crises occur, wealthy individuals and large financial institutions sometimes move money into Singapore. Banks may see increased deposits. Investment funds may shift assets into Singapore-based markets. Currency traders may buy Singapore dollars because they view it as a stable currency. This inflow of capital can strengthen the Singapore dollar. Financial institutions in Singapore may experience increased activity. Property markets may also see additional demand from international investors seeking stability. However, Singapore is still deeply connected to the global economy. In the short term, its stock market may fall together with global markets. But due to capital inflows and strong financial institutions, recovery may occur more quickly compared to other regions. Certain sectors may benefit from Singapore's position as a trade and financial hub. Banking institutions may experience increased capital inflows. Commodity trading firms may benefit from volatility in global energy markets. Logistics companies may become more important as trade routes shift during wartime conditions. What happens to major investment assets? Let's now look at how different investment assets typically behave during war. One of the most well-known safe assets is gold. Gold has served as a store of value for thousands of years. Unlike stocks or currencies, gold does not depend on the financial health of any particular country. Because of this, investors often move into gold when geopolitical uncertainty increases. Another asset that often rises during conflict is oil. Wars frequently disrupt energy supply. When supply becomes uncertain, prices rise. Energy producers may benefit significantly from these price increases. Government bonds issued by stable countries are also considered safe assets. Investors often purchase bonds from governments with strong credit reputations. These bonds provide predictable returns and relative stability during uncertain times. Finally, there are digital assets such as Bitcoin. Bitcoin did not exist during most historical conflicts, but its role during geopolitical crises has become a subject of debate. Some investors view Bitcoin as a form of digital gold. It is decentralized and operates outside traditional banking systems. However, Bitcoin can also behave like a risk asset during market stress. Because of this, its performance during crises has been mixed. The big lesson for investors. The most important lesson from financial history is that war does not destroy wealth equally. Instead, war often transfers wealth between different assets, industries, and countries. Some investments fall sharply, some rise dramatically. Some regions attract capital while others lose it. There are three key principles investors often follow during uncertain times. First, diversification helps protect wealth. Second, safe haven assets become extremely important. And third, politically stable countries often attract global capital during crises. At the end of the day, the real question is not whether markets crash during war. History shows that they often do. The real question is whether your money is positioned to survive it. Because when the next global crisis begins, investors around the world will ask the same question we asked at the start of this video. What happens to my money? And more importantly, is my money prepared for what comes next?